It may seem obvious, but investment wisdom is often reflected in what you don't have in your portfolio. Meaning, avoiding mistakes is just as important as capturing success. But human perception, being what it is, can make it difficult to recognize the importance of what didn't happen, or even see what didn't happen. You don't see what you don't see, and big mistakes are rarely reported in the media or discussed. Certainly not at cocktail parties. What ends up happening is that we talk about successes. This is called survivorship bias, meaning we focus on the survivors, the successes, because dead men tell no tales. We feel that financial journalists would do their readers a huge favor by having an investment obituary page. Rather than stoke the FOMO fire with stories of things that go to the moon, it would be good for investors to be occasionally reminded of how easy it is to flirt with disaster. Where does it all begin? Well, picture this. A new sector or idea begins capturing the zeitgeist, and financial promoters seize the opportunity by creating enticing products. Crypto's the future, and we've got a Bitcoin fund. Marijuana will revolutionize medical and alcohol sectors. We've got you covered. And there the seduction begins. You may have heard of a firm called Morningstar. They're the ones that attach 5-star ratings, 4-star ratings, or 3-star ratings to investment products. They also regularly publish research showing the outcome of individual investors against the investments they actually invest in. Let me say that again. They look at the results of investors compared to the underlying investment. Now, you would think that the outcomes would be similar or even favor that of the investor because the investor is the intelligent, sentient being. Well, spoiler alert, investors always perform worse than the actual investment. In November, Morningstar looked at theme-based investments like technology or ESG. The study found that the average annual rate of return for the funds was 7.3% a year over 5 years, while the average investor in those funds saw a return of only 2.4% a year, a shortfall of nearly 5%. ETFs, or exchange-traded funds, often touted for their low fees and intraday tradability, fared even worse. Energy transition ETF investors suffered a shortfall of 11.9%, while technology ETF investors saw a shortfall of about 7%. That's 11.9 and 7% per year for 5 years. One of the technology funds that they highlight is the ARK Innovation Fund, led by Cathie Wood. As of November of 2023, the 5-year return on the ARK Innovation Fund was 2.4% per year. Now, you might think that investors in those funds earned 2.4% over the last 5 years, where a $1,000 investment grew to about $1,100. But the story is way more interesting. 5 years ago, ARK Innovation Fund had about $1 billion in it. Yet, the total dollars lost in the ARK Fund over the past 5 years is about $17 billion. What? How do investors lose $17 billion in a fund that was $1 billion in 2019? How do you lose $17 billion when the fund had a 5-year annual rate of return of 2.4%? Here's how it happened. In 2019, the ARK Fund had $1 billion in it. Over the course of the year, it had a return of 36%. So that $1 billion grew to $1.36 billion. But people added money to the fund, so at the end of the year, it had $1.8 billion in assets under management. So far, so good. In 2020, the return was an eye-popping 158%. This means that the $1.8 billion at the start of 2020 would have grown to about $3 billion by the end of the year. It was in this year that Cathie Wood, the portfolio manager, was named the best stock picker of 2020 by Bloomberg News editor-in-chief emeritus Matthew Winkler. Now, I think we can all guess what happened next. After the spectacular performance in 2020, about $24 billion of new money poured into the fund, so that by February 2021, they had $27 billion in assets under management. Unfortunately, this new money arrived just in time for a minus 23% in 2021. So the 27 billion fell by 23%. And it gets worse. The decline of 23% was followed by a minus 67% rate of return. So the 27 billion peak in assets suffered a staggering loss of 75% over the following 2 years. It works out to a loss of about $17 billion. The saga continues. With the rebound in markets in 2023, the return to November was 50%. It had gone up 50%. And technology-themed stocks led the market. Yet, people pulled $825 million from the fund even as it went up by 50%. It's the mirror image of the previous years. People are taking money out after being clobbered by the loss. Or put more simply, people are buying at the top and selling at the bottom. The opposite of what we're supposed to do. The industry term for getting thrashed both ways is whipsawed. We call it driving in the rearview mirror. Either way, it is incredibly destructive behavior. One message from this painful story is another of the golden secrets to successful investing. Investment success is not about trading rapidly, or unique insights, or nice new ideas, or insider information. It is about temperament. It is about not chasing big returns and thinking that this ridiculous good luck will be repeated year over year. It is about investor behavior. It is having the courage to stay invested in your high quality, long-term investments, even as others silently chuckle at you for being out of fashion, or you fight the urge to scratch the FOMO itch. It is about not putting money into whatever has shot the lights out in the last block of time. Time in the market will always beat timing the market. A good advisor acts as an emotional counterweight, providing the courage to persevere in times of fear and fortitude to stay the course when everyone else seems to be getting rich and passing them by. We will continue to act like this. If you have any questions, feel free to give me a call.